So good morning or good afternoon, dear ladies and gentlemen. It is my sincere pleasure to welcome you to today's session covering the Multilateral Instrument, or MLI for short, and its impact on your business. With more than 70 signatories, the MLI represents one of the most important changes to cross-border tax norms as of today. As for Malaysia, it became a signatory to the agreement in 2018 and just recently deposited the instrument of ratification with the OECD in early 2021, with the MLI entering into force for Malaysia on 1st June of 2021. It is my sincere pleasure to introduce my valued colleagues Priya Selvanathan, Head of Tax and Transfer Pricing for the ASEAN region, and Prabu Chaloraju, Senior Tax Consultant with Rödl Partner Malaysia, who will join us as expert speakers today. As for the technical side, just let me quickly guide you through the most important points. Most of you will probably be familiar with that anyway. On the top right corner of your screen, you will find the dashboard. Here you may choose between audio or headset as for the audio settings. And a little further down, you will find the most important part, the question panel. Please do insert all your questions here for us to take care of. Be it questions to the MLI itself or technical issues. You may do so anytime during the webinar, as it will cause no irritation or disruption to the program, and it will be our pleasure to take care of these either technical issues during the webinar in the background or to the questions to the MLI. We will attend to these later in the Q&A session at the end of this session. So I hope everybody feels familiar with this. And with this being said, it's my pleasure to leave the stage to Prabu to start with the actual session. Thank you very much.
Thank you, Bettina. Hi, everyone. Welcome and thanks for signing up for this webinar. My name is Prabu Chaloraju, and I'm part of the Rödl Tax Consulting team. My work largely involves helping businesses with Malaysia and Singapore tax matters, in addition to international tax advisory issues they may face. Today's webinar is about creating awareness on the implication from implementing the MLI, Multilateral Instrument, in Malaysia. The MLI is essentially a reformation in the international tax landscape because it changes altogether how avoidance of double taxation provisions should be read and application of the relevant articles in the tax treaties. What it does, essentially, it is a mechanism for governments to close loopholes in their bilateral tax treaties, improve dispute resolution, prevent artificial avoidance of PE status, and also neutralize hybrid mismatch arrangements where taxpayers are gaining tax advantage by having structures like debt in one country and equity in another. Now, who does it really concern? I mean, what kind of businesses should really need to be aware of these MLI positions by the Malaysian tax authorities? It affects Malaysian businesses with presence outside of Malaysia. Any company who is part of an international group that is operating in Malaysia, any company involved in cross-border transactions, especially in countries which endorse the MLI. Now, first half of the webinar, I will run through with you the background, how the MLI takes effect in Malaysia, and the technical aspects of the MLI provisions. And then my colleague Priya will then take over to run through the application of the MLI provisions through case studies using common cross-border arrangements which Malaysian businesses typically have in place. And finally, we will discuss how companies in Malaysia should move forward. Next slide. Now, I think we will start with the background of how this MLI come about. The OECD initiated the BEPS project to tighten the gaps which companies exploit to avoid taxation by artificially shifting operations in order to reduce tax costs at group level. One of the BEPS action, particularly Action Plan 15, provides changes to bilateral tax treaties to address this issue. As changes to individual bilateral tax treaties can be time-consuming and administratively tedious, the MLI is developed to overcome these constraints. The MLI provisions allow countries to swiftly adopt the mandatory overarching provisions like the principal purpose test, and some optional provisions which give the countries flexibility whether to adopt or not. So these MLI provisions are not the same for all countries. It depends on the positions which the individual countries took, and it also depends on the respective countries which Malaysia signed treaty with, whether the positions are the same. I will discuss this later on further. Next slide, please. So over here, we are going to discuss on the MLI milestones. You can see that Malaysia joins the BEPS Inclusive Framework on the 27th January 2017, followed by 24th of January 2018. Malaysia signs MLI and submits the agreements of about 73 jurisdictions that it wishes to designate as covered tax agreements. So for the MLI to kick in, the relevant treaty has to be a covered tax agreement. So Malaysia has to list the number of countries that it wishes to effect the MLI provisions, along with its position and reservation. So as I mentioned, there are mandatory provisions like the principal purpose test, and also optional provisions which countries can choose. So Malaysia has deposited proposed on the 24th of January 2018, and then on 28 December 2018, the domestic tax laws amended to enable the ratification of the MLI, followed by the MLI Gazette order on the 4th of August 2020, and then the instrument of ratification along with the final MLI positions, which is already concluded by Malaysia, is deposited with the OECD, and typically generally 3 months from the date of this deposition of the instrument ratification, the MLI takes into force. So in Malaysia, it is on the 1st June 2021. Which is the 3 calendar months after Malaysia deposits instrument ratification, 18 February 2021. Now this, the way it works is the same for all the countries. And you can see later on how we compare the dates when we compare with the relevant country in question in relation to the transaction. Next slide, please. So over here, as you can see, 3 months from the deposit of the instrument of ratification with the OECD, the MLI is in force. However, different rules apply as to how the MLI enters into effect. I would like to first bring you back to how to check if MLI applies. For example, if Malaysia and country A have ratified the MLI, the bilateral DTA between Malaysia and country A will be amended only if both Malaysia and country A indicate that they would like to amend their bilateral DTA using the MLI. In the MLI context, that DTA is referred to as covered tax agreement. In short, we call it CTA. Once we have determined there is a covered tax agreement, a CTA in place, the next thing is to check if the provision of the MLI applies. A provision in the CTA will be amended by an MLI provision only if both Malaysia and country A have taken the same position regarding the provision in the MLI. The MLI position of countries with CTA, including Malaysia, are available on the OECD website. You can actually go into the website straight away and then look into all the countries' position there. Once we have determined there is a CTA and both Malaysia and the relevant country, say country A, has the same MLI position in respect of the particular provision, the next step would be to determine the commencement date for when the MLI would take into effect, because different rules apply as to how the MLI enters into effect depending on the nature of tax. So you can see here for withholding tax, the MLI provisions apply on or after the first day of the next calendar year that begins on or after the latest of the dates on which MLI enters into force for each of the party. So what's important here is if you have country let's say Malaysia and another country, which I would run through an example later, you look into the latest date where the MLI is in force. If Malaysia is the latest date where the MLI is in force in Malaysia, compared to the other country, then we take the latest date. And first day of the next calendar year, that's where the withholding tax would apply. This applies for all the other countries as well. For other taxes, like capital gains tax, individual tax, the MLI provisions apply on or after the expiry of 6 calendar months from the latest of the dates on which is the same thing. So the only different thing is for other taxes like capital gains tax and individual tax, the transaction in question that needs to be looked into is after 6 months when the MLI is in force, the latest MLI date. I will run through with you an example in the next slide. Next slide, please. Yeah, so you can see here we have taken UK as a comparison. So UK deposited its instrument of ratification on 29 June 2018, and therefore 3 months down the road, the MLI is in force on the 1st October 2018. However, for Malaysia, the deposit of the instrument of ratification is on the 18th February 2021 with the OECD. Therefore, 3 months down the road, the MLI is in force on 1st June 2021. So any transaction that is in question in relation to withholding tax or other taxes, the first date that we should take, the date that we should take is the latest date, which is 1st June 2021. So for withholding tax, we start with when the latest date of Malaysia, the latest date when the MLI enters into force for each of the contracting jurisdiction, in this case Malaysia, that is 1st June 2021. And then you refer to the first day of the next calendar year. So the MLI provision have an effect for that withholding tax transaction occurring on 1st June 2022. 1st January 2022, which is the first day of the next calendar year. For other taxes, again, you start with the MLI in force date, the latest date. In this case, it is 1st June 2021. And the expiration of the period of 6 months, that would result in those transactions to be reviewed starting 1st December 2021. I hope that makes sense. You don't have to worry too much about this because we'll be distributing the slides later. Next slide, please. Okay, so in this slide, we will discuss the key changes to the Malaysian tax treaties, the optional and the mandatory provisions which the Malaysian tax authority has adopted and is in force. Okay, so we have summarized it. There are many provisions that Malaysia has adopted, but there are also many provisions that Malaysia has reserved, which means they don't want to adopt. These are optional provisions. We have summarized it into 3 broad categories. The first is preventing tax treaty abuse. The next is widening of the PE scope. And the last is improving dispute resolution. I will start with the dispute resolution because we do not have much guideline from the Malaysian Tax Authority, but essentially Malaysia adopted the MAP, the mutual agreement procedures provisions to its covered tax agreements. This is a minimum standard under the BEPS Action 14. So when a Malaysian resident taxpayer encounters taxation issues such as undue taxes by the foreign authority or the Malaysian Tax Authority, or different tax position adopted by the foreign tax authority against the position adopted by the Malaysian Tax Authority, then the taxpayer could request for the MAP to be presented to either competent authority. It can be Malaysia or it can be the counter country to resolve the dispute. There are procedures, systematic procedures involved, and Malaysia has yet to issue a guideline on this, so we will wait for that, and perhaps we can have a separate seminar or a webinar on that. Now, the most important part in today's webinar is to understand what it means by preventing the tax treaty abuse. There is an inclusion of a statement of intent with respect to the covered tax agreement signed with Malaysia, that the tax treaty is to eliminate double taxation without creating opportunities for tax benefits through tax evasion or avoidance. The mandatory test which Malaysia has adopted is the PPT test, which is called the Principal Purpose Test. Under the PPT, treaty benefits will be denied if it is reasonable to conclude from the facts that the principal purpose or one of the principal purposes of entering into a transaction or an arrangement was to obtain such tax benefits. And there's an exception there, unless the transaction is in accordance with the object and purpose of the treaty. So based on this PPT test, taxpayer needs to consider this. Under this test, taxpayer needs to submit the reasons to the Malaysian Tax Authority for the transaction and whether obtaining tax benefit is one of the principal purpose. If it can be satisfied with supporting documentation that obtaining tax benefit is not a primary purpose, then the Malaysia Tax Authority may not probe further and taxpayer can enjoy the treaty benefit. However, where the reasons provided are not satisfactory, the Malaysia Tax Authority would objectively assess whether granting the tax benefit is in accordance with the object and purpose of the particular treaty provision. How it will be assessed? It will be assessed objectively based on relevant facts and studying the structure and arrangement as a whole. Again, the Malaysian Tax Authority has yet to issue any guideline on the queries or the documents required or how it will systematically look into assessing the test. However, we expect some of the questions like, does the arrangement result in the taxpayer obtaining a benefit under the relevant treaty? There could also be a question on discrepancy between the substance of what is being achieved under the arrangement and the legal form it takes. The substance over form consideration has been kicking in the past lately. And questions like, does the arrangement involve the change in character of payments or a mischaracterization of payments? For example, service fees rather than royalties, interest rather than business profits. What are the functions, assets, and risk of each entity in the arrangement? Does that entity possess that necessary competencies and capacity to manage its functions, assets, and risk? These are the kind of questions that the Malaysian Tax Authority, we expect them to ask. If you're wondering the kind of documents, I think it would be documents that typically they would ask, such as first, probably a general submission on the views about the application of the principal purpose test. It will be the views of the taxpayer. Any contemporaneous transfer pricing documents where related parties are involved, intercompany agreements and company policies, presentations of papers presented to the senior management team and board of directors. This info can be quite confidential, but the Malaysian tax authorities are empowered to us to assess the PPT test, as well as any other commercial, regulatory, and tax advice relating to the arrangement in question that the taxpayer has sought prior to implementing the arrangement. So that is on the on the prevention of the tax treaty abuse. And next is the widening of the PE scope. So basically, the rules spell out that what we know and how we strategically avoid or mitigate the risk of triggering a PE in Malaysia is being reinvented here. The threshold is even lower to trigger a PE. That means we need to relook at the strategies that we have implemented before in mitigating a PE in Malaysia. The first is the broader agency PE. Now, under Article 5, subsection 5 of the tax treaty, the provision for agency PE is amended to widen the threshold for agency PE to address the artificial avoidance of PE status through commissioner arrangements and similar strategies. Now, the existing provision states that a taxpayer, loosely, a taxpayer acting on behalf of an enterprise habitually exercises an authority to conclude contracts in the name of the enterprise. Now, this is what we know, but the new provision states that an an agency PE is triggered where taxpayer habitually concludes contract or habitually plays the principal role leading to the conclusion of contracts that are routinely concluded without material modification by the enterprise. So these changes is to target companies providing marketing services or civil law commissioner arrangements. The new provision also states that if a taxpayer acts exclusively or almost exclusively on behalf of a foreign company, which is closely related, the taxpayer should not be considered to be an independent agent. So the exception to triggering an agency PE by way of agency by independent status is also watered down. The next would be the optional provision, which is the specific activity PE exemption. Now, under Article 5, subsection 4, if you read the tax treaty, generally any tax treaty that Malaysia has signed with, it provides an exception on activities from triggering PE by the foreign taxpayer. So those activities are listed under A to F. For example, Part A says that the use of facilities solely for the purpose of storage, display, or delivery of goods. Now, the rule that, as we know it, is there's A, B, C, D, E, and F. Particularly on Part E, it states that the maintenance of a fixed place of business solely for the purpose of carrying on any other activity of preparatory or auxiliary character. And Part F states that the maintenance of a fixed place of business solely for any combination of activities mentioned in subparagraphs A to E. Now, the existing rule that we all know is that the words preparatory or auxiliary character condition is to be met only by the exception under the provision subsection E and F. But the new rule states that the preparatory or auxiliary character condition to be met by each of the exception under A to F, all of them. This means that all the exception activities have to meet the preparatory or auxiliary condition. Now, not all countries adopted it. You can see later in the example, certain countries choose to stick with the existing rule, but Malaysia adopted all. So those arrangements in relation to these activities need to be relooked and need to be ensured that they are all preparatory or auxiliary. The test for this need to be satisfied for all the activities. And finally, the anti-fragmentation rules. Essentially, these anti-fragmentation rules prevent an arrangement to be viewed in isolation. So, for example, if the activities are preparatory and auxiliary condition, let's say we have passed this test, it is still not end of the story. The next thing which needs to be considered is whether the anti-fragmentation rules are observed. So this rule is about, even though the activities satisfy the preparatory or auxiliary condition, but if the arrangement constitute part of a larger set of business activities, where the combined activities constitute complementary functions that are part of a cohesive business operations, then the anti-fragmentation rules will prevent the application of the PE exception rule under Article 5, subsection 4, even though the preparatory and auxiliary condition is met. So this is again an overarching test that Malaysia has adopted. Again, not all countries have adopted the anti-fragmentation rule, but with this rule, the Malaysian Tax Authority will ask the entire structure, the entire value chain of transactions, not only looking at that particular transaction, but how does that transaction came about, what is the flow-through transaction, and what is the ultimate object of that transaction. They may even request documents that may not be kept by the Malaysian company, but it could be this could mean that the Malaysian tax authorities would require access to other documents that are even more private and confidential. So I think the anti-fragmentation rule is very important that we need to take a particular look at. Yeah. Next slide. Now, in this slide, you can see how we can compare the position that Malaysia has adopted with other countries. Over here, we have chosen Singapore and Australia. So you can see that the wider agency PE rule that Malaysia adopted Singapore did not adopt it. Therefore, even though there is a covered tax agreement between Malaysia and Singapore, that particular transaction in relation to this agent PE will not apply in respect of the MLI provision that Malaysia has adopted. If you look at the specific activity exemption, Malaysia has opted to apply the preparatory and auxiliary condition for all the subsections A to F, but Singapore decided to maintain the existing rule, which means that the condition only applies to part E and F. Therefore, the MLI provisions do not apply in transactions in relation to Singapore. The anti-fragmentation rule has been adopted by Malaysia. This is an optional provision, so Singapore has not adopted this rule. Therefore, the MLI impact for transactions involving Singapore and Malaysia will not apply. In comparison, you can see that for Australia, it's similar with Singapore. Australia did not adopt the wider agency PE rule. Therefore, the MLI provisions will not impact the transactions that in relation to the agency PE between Malaysia and Australia. However, you can see that specific activity exemptions, both Malaysia and Australia decided to adopt the preparatory and auxiliary conditions for all the parts A to F. Therefore, this transaction, where there's a transaction between Malaysia and Australia to determine a PE under this activity, the MLI provisions apply. That means the transaction needs to be looked at for the entire activities and whether the entire activities satisfy the preparatory and auxiliary condition. The anti-fragmentation rules have been adopted by both Malaysia and Australia. Therefore, any transaction involving Malaysia and Australia, any transaction at all, because this anti-fragmentation rule is an overarching rule, so both Malaysian and Australian tax authorities may actually request further information to have a big picture and to understand what the transaction is all about and the purpose of the transaction. I'll pass down this webinar to Priya to run through some case studies with you so that you understand how the application of the MLI in practice works.
All right, thank you, Prabu. Okay, now that you've got quite a good and detailed understanding of, the background of the MLI and what it entails, especially for Malaysia, as we, look into this as it comes into effect, starting from next year, basically. So let's look at some case studies here. I have a few case studies. So let's look now at the first one with a very simple one. Let's start with a very simple case study. And on the left, we have a very simple holding company and subsidiary structure. So we have MYCO in Malaysia, and it has a subsidiary, which is XCO in country X. Country X imposes dividends at a withholding tax rate of 30%. And so what if, in order to minimize the group's tax exposure, the group then considers interposing an intermediate holding company, that is YCO, in country Y? In this case, we can see from the diagram here on the right-hand side that under the treaty between XCO and YCO, there is a reduced dividend withholding tax rate of 10%. So in this case, can the reduced tax treaty rate of 10% apply? So let's look at how we can determine this. And Prabu has also spoken about this in quite some detail. Can we go to the next slide, please? So first, we have to look at the subjective test. So we need to ask ourselves the question, was obtaining the benefit or the treaty benefit one of the principal purposes of the arrangement or the transaction that resulted directly or indirectly in that benefit? So it's important to look here at some of the keywords. The first would be the principal purpose. So this means that obtaining the tax benefit does not have to be the sole purpose, but merely the principal or the main purpose. And then the other keyword here to look at is directly and indirectly. So if we can answer that obtaining the benefit under the treaty was not the principal purpose of this arrangement, then the treaty benefit should be allowed. But if we answer yes to this question, then we need to look at the second test, and that is the objective test. And under the objective test, we need to determine if the granting of the benefit is in accordance with the object and purpose of the relevant tax treaty provisions. So how do we determine the objective of a tax treaty? So most of us will simply look at the tax treaties just for applying reduced withholding tax rates or the definition of a PE. So the main thing to look at here is if the answer to this is no, then the treaty benefits would not be allowed. But if the answer to this is yes, then the treaty benefits should be allowed. Can we go to the next slide, please? So let's look at an example here under the Singapore-Malaysia Double Tax Treaty. So with the introduction of the MLI provisions, these new provisions have been included in the tax treaty. So Article 27A is a new one, which deals with the prevention of treaty abuse. So that is primarily the principal purpose test. So this article states that a benefit under this tax treaty shall not be granted in respect of an item of income or capital if it is reasonable to conclude, having regard to all the facts and circumstances, that obtaining the benefit was one of the principal purposes of any arrangement or transaction that resulted directly or indirectly in that benefit, unless it is established that the granting of the benefit is in accordance with the object and purpose of the provisions of the agreement. Now, what is the object and purpose of the provisions of the agreement? So this is where we looked at the objective test again. So how do we determine what is the objective of the double tax treaty? So is it again merely to obtain reduced withholding tax rates or to give us definition of PE? So for this, we need to look into the preamble of the agreement. So looking here again at the example of the Malaysia-Singapore Double Tax Treaty, it reads, the government of Singapore and the government of Malaysia intending to eliminate double taxation with respect to the taxes covered by this agreement without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance. And this includes through treaty shopping arrangements aimed at obtaining reliefs provided in this agreement for the indirect benefit of residents of third jurisdictions. So now let's go back to the first case study. So can we get the next slide again? So now going back to this case study, can the reduced tax treaty rate apply? So applying first the subjective test, what is the principal purpose of this arrangement? If we answer that it is to obtain a benefit under the tax treaty, which is simply to obtain a reduced dividend withholding tax rate, then we need to then look at, then you answer yes to the principal purpose test. And then we need to look at what is the objective test. So is the benefit in accordance with the purpose of the double tax treaty? If the answer to that is no, and taking the example from the Singapore-Malaysia Double Tax Treaty, then the tax treaty benefit would not be allowed. Next slide. So let's look now at another case study. So in this case study, we have company A, that is a manufacturer in country A. So it is looking at relocating its manufacturing operations to another jurisdiction with a view of reducing its operating expenses. It's considering either country X, country Y, or country Z. So in carrying out its feasibility studies to move its manufacturing operations, it considers the economic and political climate of these countries. At the same time, it also considers the withholding tax rate on dividends imposed by these countries. And under the domestic tax legislation, countries X, Y, and Z all impose withholding tax at the rate of 20%. But under the double tax treaty between country A and country Z, there is a reduced withholding tax rate on dividends. So in this case, if they decide to move the manufacturing operations to country Z, will the treaty benefit between country A and country Z be allowed? So let's go back again to those two tests. Okay, the subjective test and the objective test. The subjective test is the first one. Okay. So what is the principal purpose of the transaction? Is it to obtain a benefit under the tax treaty? Well, we know based on the facts that the principal purpose of moving the manufacturing operations is an operational reason. That is, it is to reduce the operating expenses. So we can say that the sole purpose is not tax reason, but is it the principal purpose? Now that will be a little bit harder to determine for sure. For illustration's sake, let's just say that it is the principal purpose. So would the objective test be met? If this is in line with the object and purpose of the double tax treaty between country A and country Z, then the treaty benefits should be allowed. But if not, then the treaty benefits should not be allowed. However, if we can say that the principal purpose of the transaction, which is moving the manufacturing operations, is not for the benefit of obtaining the treaty benefit, then the treaty benefits between country A and country Z should be allowed. And next slide. So looking now at another case study here. So we have company F that's located in country F. And company F has 5 subsidiaries in the Asia Pacific region. And country F doesn't have a tax treaty with all these countries. And so company F is now looking at setting up a regional headquarters in a separate jurisdiction to provide group services such as management services, finance services, HR, IT, etc. So company F decides, after carrying out all its internal studies, that it will set up its regional headquarters in country G. They decide on country G primarily because of the infrastructure in the country, the labor force, the robust legal system. So in addition to this, country G also has tax treaties with all the 5 subsidiaries in FCO. So this provides reduced withholding tax rates. So in this case, can we say that the treaty benefits provided under the tax treaties between country G and countries A, B, C, D, and E apply? So, I mean, in this case, how is it different from the second case study? We can see a bit clearer here that the principal purpose or the main intent of entering into this arrangement is mainly for operational reasons. The fact that that country G has treaties with countries A, B, C, D, and E is a benefit, yes, but the main reason for this is primarily that they want to set up a regional headquarters to carry out group functions, and the main reason for setting up in country G is because of the infrastructure. So it's not driven by tax purposes, but instead by commercial reasons. So we can see quite clearly here that the principal purpose is for operational and commercial reasons. So company G seems to have the substantive business activities with which will also have significant group functions carried out. So the principal purpose, we can say, is not likely to obtain the tax benefit. So in this regard, we can probably say that the treaty benefits should apply. So as we can see from some of these examples, it can actually be quite difficult to determine the principal purpose of a transaction or arrangement. It all comes down to the facts and circumstances. And it's in general quite difficult to substantiate your intention. How do you prove intent? But that's exactly what the tax authorities are looking for. So as a taxpayer, we would need to be able to provide evidence on the intention or the principal purpose or objective into entering into such transactions. So the Malaysian tax authorities, they have not yet issued any guidance on this matter. But some of the ways that as a taxpayer, you can already start to manage some of these risks is by asking yourself some of these questions. Does the arrangement result in the taxpayer obtaining a benefit under a relevant tax treaty? Do you see a discrepancy between the substance of what is being achieved under the arrangement and the legal form that it takes? So substance over form. Does the arrangement involve a change of the character of payments or a mischaracterization of payments? Very important thing to consider is the functions, the assets, and the risk of each entity in the arrangement. Does each entity in the arrangement have all the necessary competencies to manage its own functions, assets, and risks? In terms of your documentations, how do you prove this? Do you have the internal documents outlining the views on the application of the principal purpose test? Do you have presentations and board papers relating to the arrangement of transactions? How was the consideration done by the board of directors? Has this been appropriately documented? Have these transactions and arrangements been documented in your intercompany agreements and transfer pricing documentation? So these are some of the questions you can start to ask yourself, and to have these things, to proactively start thinking about this and have these in place so that when there is guidance, you are in a better place already to manage these risks going forward. Can we have the next slide? Now let's look at some PE related case studies. In this case here, we have Indiaco, that is a tax resident of the UK. And Indiaco rents a warehouse and stores its goods in Malaysia because the majority of its customers are based in Malaysia. When the customers need the goods, Indiaco will arrange for a third-party logistics provider to pick up the goods from the warehouse and send the goods to the Malaysian customers. So will the warehouse create a PE of Indiaco in Malaysia? Next slide. Now, let's look at how we can tackle this. And again, this I think has been discussed as well briefly by Prabu. So in Article 5, Paragraph 4, it sets up the negative list of the fixed place PE. So those are the exception criteria. So it sets out the list of activities deemed not to constitute a PE. In the existing article, the preparatory and auxiliary character condition only needs to be met by two exemptions. The maintenance of a fixed, number one, the maintenance of a fixed place of business solely for the purpose of carrying on for the enterprise any other activity of a preparatory or auxiliary character. And the second one, the maintenance of a fixed place of business solely for any combination of activities mentioned in the above paragraphs. Now, I won't get into the details of the paragraphs on the exclusion criteria. But if you're familiar with the PE articles in double tax treaties, it's largely around the facilities, use of facilities for storage, display, and delivery of goods, and etc. So now with the introduction of the MLI provisions, the preparatory and auxiliary character condition is no longer limited to only one or two exemptions. The preparatory or auxiliary character condition has to be met by each of the exceptions. And in the UK-Malaysia double tax treaty, it reads, the maintenance of a fixed place of business solely for any combination of activities mentioned in paragraphs A to E, that is the other exemption conditions, provided that the overall activity of a fixed place of business resulting from this combination is of a preparatory or auxiliary character. Next slide. So now going back to this case study again, will the warehouse of Indiaco create a fixed place PE of Indiaco in Malaysia? So if this was pre-BEPS, I think we can safely say that one of the exemption conditions would apply and there would not likely be a PE in Malaysia. However, in a post-BEPS era, we need to look into if the warehouse of the UK company in Malaysia is preparatory or auxiliary in nature. For this, we need to look at the function of the UK company. If the UK company is a trading company, it would be very hard to argue that the warehouse rented for the purpose of making sales in to Malaysian customers is of a preparatory or auxiliary character, because it forms the crux of the trading operations. So in this case, it is a likelihood that the UK company will have a PE in Malaysia. Next slide. So in this next case study, we have Indiaco, which is a company that is tax resident in India. And Indiaco has rented a warehouse and stores its goods in Malaysia. The goods are to be sold by sold to a related company in Malaysia, that is MYCO. So, and when the Malaysian customers need the goods, MYCO will pick up the goods from Indiaco's warehouse and deliver them to the customers. So will the warehouse of Indiaco create a fixed place PE of Indiaco in Malaysia? Now, in this case, we need to look at the activities of the group as a whole. In the past, it was quite easy to circumvent a PE by ensuring that the negative limb conditions of a PE under a double tax treaty were met. But with the tightening of the conditions for exemptions for preparatory or auxiliary conditions, it becomes harder to circumvent a PE. In addition, in the past, it was quite common to fragment a cohesive business operation into smaller operations in order to argue that each small part are preparatory or auxiliary activities. But now it becomes harder to do that. So these changes in the PE threshold now also include anti-fragmentation rules. What does this mean? This effectively means that it may no longer be possible to provide an exception from PE status for activities that might be viewed in isolation as preparatory or auxiliary in nature, but constitute a larger set of the business activities conducted in the source country. So either alone or with a related party. So if the combined activities constitute complementary functions that are part of a cohesive business operation. So looking at this example, we can clearly see that this entire structure forms the combined activities constitute complementary functions that are part of the cohesive business operation. So applying the anti-fragmentation rules, we can no longer look at the activities of the Indian company and the activities of the Malaysian company in isolation. They have to be the activities of the Malaysian company and the Indian company, as well as the warehouse of the Indian company, are all closely related. So as such, the warehouse could likely trigger a PE for the Indian company in Malaysia. And what happens actually when a PE is triggered? So when a PE is triggered, that effectively means that there has to be profits attributable to the PE that would be subject to tax in Malaysia at the current corporate tax rate. So then there will also be the added compliance obligations, as well as you would have to file tax returns in Malaysia. And there will also be the added complication of how do you then allocate the profits to the PE. So these are some of the things to think about. Next slide. And let's now look at a few case studies on agency PEs. So in this case study, we have a UKCo, which is a tax resident of the UK. They have an agent in Malaysia, MY agent, and MY agent concludes contracts with MY customers on behalf of UKCo. So should the profit from the sale of goods be subject to Malaysian income tax? So Article 5, Paragraph 5 of the Double Tax Treaty deals with agency PEs. So pre-implementation of the MLI, it was enough that a PE would be created if an agent was acting on behalf of an enterprise and they habitually exercise an authority to conclude contracts in the name of the enterprise. So in this case, it seems quite straightforward that and it seems that the profits from the sale of goods should be subject to tax, to Malaysian income tax. But now what if the MY agent was an independent party? In other words, what if MY agent was a broker or an independent agent that was acting in the ordinary course of its business? So in this case, it's not likely that UKCo will create an agency PE in Malaysia, and the profits from the sale of the goods should not be subject to tax in Malaysia. Next slide. So as you can see on this slide, I've highlighted some of the key terms of the dependent agent and independent agent pre-MLI and post-MLI. So you can see that post-MLI, the conditions surrounding agency PE have been tightened. So now the mere fact that you have an agent that habitually plays the principal role leading to the conclusion of the contracts that are routinely conducted without material modification by the enterprise could give rise to a PE. So these new conditions could specifically affect marketing service company structures. So the conditions for independent agents have also been tightened. So it's also now no longer enough that an independent agent is acting in the ordinary course of their business. They must also not act exclusively or almost exclusively on behalf of an enterprise to which it is closely related. So there is still no firm definition on what it means to be almost exclusively. But in the OECD commentary, it's generally understood that almost exclusively means something to be more than 90%. Next slide. So that then brings us to the next case study. So similar facts as the previous one, except in this case, the MY agent also provides agency services to related companies of Indiaco as well. In this case, will the profit from the sale of the goods be subject to Malaysian income tax? So looking at the rules for independent and independent agent, it's likely in this case that MY agent cannot be regarded as an independent agent since it is acting based on the facts that we have exclusively for Indiaco and its related parties. So as such, it's likely here that there could be a PE exposure and the sale of the goods could be subject to tax in Malaysia. Next slide. So let's now look at one final case study here. Here, we look at a typical marketing service company arrangement. So in this example here, we have Indiaco that receives marketing services from its related company, MY Marketing Co., which is in Malaysia. MY Marketing Co. will then liaise, communicate, and negotiate contracts with customers in Malaysia. The conclusion of the contracts, however, for the sale of the goods will be done between Indiaco and the Malaysian customers. In this case, will the profits from the sale of the goods be subject to Malaysian income tax? So let's look back at our previous discussion. It's important to look at the actual functions of the MY Marketing Co. Are its activities akin to that of an agent? Is it habitually playing the principal role leading to the conclusion of the contracts with MY customers? Based on the facts that we have, it certainly seems so. Seems that MY Marketing Co. does everything except sign the contract with the customer. So based on this, it seems that MY Marketing Co. could potentially create a PE for the Indian Co. in Malaysia. And the profits from the sale of the goods needs to be allocated to Malaysia where it can be taxed. So also we need to look at what is the functional analysis of MY Marketing Co. And this may need to be revisited in light of the new MLI provisions, and higher returns may need to be allocated to the MY Marketing Co. So the changes to the agency PE conditions could mark the end for marketing and sales support companies. So for such structures, I think we need to really analyze the impact of the group structure and see if there are any changes that need to be made and if there's any readjustments to the profit allocation. Next slide. So what now? I mean, we've discussed in quite great detail, about the MLI, the changes, and how it, and gone through some examples of how the MLI provisions could impact, your existing structures or your structures that you intend to implement moving forward. So what should you be looking at? So the MLI provisions will certainly have an impact on new arrangements, but what about your existing structures and your existing arrangements? You should start to look into your existing operating structures or any intended new arrangements and review these with the MLI provisions in mind. You should also check whether the relevant treaties are modified by the MLI. So check whether the specific country has a covered tax agreement with Malaysia, as the MLI provisions, as we know, are only effective on covered tax agreements. Then assess when the MLI provisions are effective. Review your cross-border transactions at the effective dates and check whether the positions adopted by Malaysia and the respective foreign jurisdiction is the same. So as mentioned earlier during the early part of this session, the MLI provisions adopted by Malaysia would only be effective where the corresponding country has adopted the same interpretation or position on the relevant subject matter. So take this time to review your cross-border transactions, plan ahead while you still have the room to restructure these transactions, so that the transactions would not be viewed as resulting in obtaining a benefit under a double tax treaty, bearing in mind the principal purpose test as well as the objective test. So it's important to remember that there always has to be a commercial decision behind every business arrangement or transaction. It is no longer okay, and I think this has already been quite clear in the recent years, that any arrangement or structure is not acceptable if it is led with an intention of obtaining a tax benefit. And with regard to marketing and sales support service structures, there is likely going to be quite significant impact here. So again, take this time to review these structures, see if there's any potential risk and how it can be mitigated. See if there's, revisit the functional analysis, the functional characterization of this company, see if there needs to be any reallocation of profits. It's not yet clear how the tax authorities will interpret this threshold in practice, but as a taxpayer, we can take mitigating steps to try to reduce the potential risk in case there are any questions from the tax authorities. So just a final thing to wrap things up here. These changes are going to be quite significant to the way businesses are being carried out today. So any future structures or transactions that you implement should always be implemented with the impact of the MLI being taken into consideration. So always take a proactive approach and review these structures before you implement them, but also at the same time revisit some of your existing structures. Don't immediately change the existing structures because sometimes it could in fact have a negative effect. So review them, and if you want to, we can have a discussion with you to see how we can mitigate some of these risks. So that's all the presentation. We're happy to take any questions if there are any.
Yeah, thank you very much, Priya, and thank you very much, Prabu, for this very complex insight into the MLI and its impact on potential business structures in and about Malaysia. I have one or two questions to ask for you. First one, how will I know if an existing tax treaty is modified by the MLI?
Prabu, do you want to take this one? I think you're muted.
Sorry. Okay. Bettina, can you repeat that question again?
Yes, of course. How will I know if an existing tax treaty is modified by the MLI?
Okay. I guess the first thing is the MLI will modify Malaysia's treaties if there is a covered tax agreement. So that is the most important thing to check. And both treaty partners share the same MLI position in that particular transaction. So let it be agency, PE, let it be specific exemption list, they both need to share the same position. And after that, the MLI entry in force date. So the date kicks in once you have checked there's a covered tax agreement, and then the MLI positions are similar, and then you check the date. The extent to which the MLI will modify these treaties will depend on the final positions at the time of ratification of the MLI of both countries. The Malaysian tax authorities mentioned that it will issue guidance to assist taxpayers in understanding how the MLI modifies the operations of the tax treaty, of that particular tax treaty.
Thank you very much. I hope that answers the question. Otherwise, of course, we are still here for you to ask more, and we will pass on the presentation slides to you. That's for sure. I have another one which is quite in the same direction and says, how will taxpayers know which double taxation agreement has been amended by the MLI?
I can take this one unless you want to take it, Prabu.
Okay. Go ahead, Priya.
Okay, so when a double tax agreement is amended by the MLI, the changes will be implemented by way of a Gazette order. So for Malaysia, the taxpayers, as taxpayers, you can refer to the LHDN website or the RMB website for all the details on all the DTAs that have been amended by the MLI and how these DTAs have been amended. There are also, so this is constantly being updated as and when there are any new MLIs being implemented.
Thank you very much. With regard to the time, I'd say we take in one more question. So how can taxpayers know the position of other jurisdictions? That's a good one. We'll want to take.
Okay. So I think the positions of the other jurisdiction can be found on the OECD website. You can also find on the OECD website the countries that Malaysia wishes to enter into a covered tax agreement, as well as the positions of the respective.
Thank you very much. So given the fact that we reached our time limit, I'd suggest we leave it here for the moment. Again, should any questions have been left unattended, we will take these down and be happy to come back to you bilaterally. And as always, I will be happy to share the slides with you upon request. And last but not least, this session has also been recorded and will be made available online later on for you or your colleagues to recap anytime you wish. So thank you very much, everybody, for joining us today. Thank you very much, Priya, and thank you very much, Prabu, for your expert insight. And I hope everybody took some helpful insights with him or her with regard to the MLI and its significant impact on quite some business structures. So looking forward to seeing you all again quite soon. Thank you, everybody. Stay safe and take good care. Bye-bye.
Thank you.
Bye.
Thank you. Bye.